Hi, it's Andy Hoffman, Media Director of Miles Franklin for my weekly audio blog. I don't have a guest today, so it's all me for the next 20 or 25 minutes, and believe me, there's a lot to talk about. Starting, of course, with the Fed's taper announcement on Wednesday afternoon of theoretically $10 billion per month from the official number of $85 billion per month, and it'll start in January. I'll get to those numbers in a second. Of course, what they actually said was far more dovish than I could have imagined, because while they supposedly are going to taper and now only spend $900 billion a year printing money and monetizing instead of $1 trillion, they also offset that by reducing the timeline or increasing the timeline of when they might actually increase interest rates until well after the jobless rate falls below 6.5% as opposed to its initial threshold of 6.5%. Of course, the reason they had to do this is because the biggest reason the unemployment rate is falling, aside from government lies about the statistics, is that the labor participation rate is hitting all-time lows each month, or should I say 35-month lows. And just next week, we're going to see 1.4 million people go off the unemployment benefit payrolls. So we may see 6.5% in the next unemployment report, even though it's only because people can't find jobs, not because people are getting jobs. On top of that, the FOMC now expects to not raise rates at all until at least mid-2015 and possibly late 2016, which in my mind is to infinity. The consensus of the Fed governors now is that the Fed funds rate at the end of 2016, that is 3 years from now, will be just 1.7%. This compares to the 60-year average of 5.2%. In fact, the last time, since Greenspan pushed Fed funds that low after he, created the bubble in 2000, that was the last time rates were pushed below 1.7% since 1961. In other words, you could see why even the Fed is screaming why they must keep rates low with all this debt around. Big recovery here, and yet rates are going to stay at record low levels for at least 3 more years. By the way, they didn't mention the other threshold they theoretically once created of when they would raise rates, being the 2.0% inflation, because according to them, there is no inflation anywhere. I mean, perhaps they should look around the world at what currencies are doing and what the cost of living is doing, or even the United Nations' own Food and Agricultural Price Index, which is at or very close to its all-time high. And by the way, here in the States, both beef and chicken prices hit all-time highs this week. And of course, remember next week, when the year ends, then Obamacare is really going to start kicking in. But I guess, beef, chicken, and healthcare don't count as inflation. In fact, when they just raised the GDP number this quarter, they announced it today from 3.6 to 4.1% growth, which is a joke to start with. The biggest reasons were due to gasoline and healthcare increases in spending. So again, no inflation here. And by the way, I mentioned in the beginning that that the taper number was a lie to start with. The piece that you'll see that I just wrote today, it'll be up on the blog. It's right now, it's Friday afternoon. I proved that the Fed has been not QEing by 85 billion per month, but since May, since interest rates went up, the number has been closer to $130 billion a month, because if you look at the Fed's balance sheet that's published constantly, it doesn't include the capital losses that the Fed's portfolio has had from the fact that interest rates have soared since they started talking about tapering at mid-year. You'll see the math that I did, and you'll realize that the Fed lies about everything. And in this case, the numbers are right out there for you to see. So it's amazing to me why this doesn't get observed. But again, we're in this era right now where people are ignoring reality solely because the stock market is up, even though the average person has no interest in the stock market. It's only that 1%. By the way, if you listen to Bernanke's press conference, when gold was sitting at its highs and then miraculously it started plunging, while he spoke. I mean, he couldn't have been more dovish if he tried. But my God, you should have heard some of the lies. For one, he said the Fed is not losing money. I mean, how could you not lose money when you have the world's largest bond portfolio, and interest rates are surging. He said, believe it or not, the labor participation rate falling was due to demographic and sociological issues, not the fact that there are no jobs out there, that the jobs have been outsourced overseas. He also said, and this was the best one of all, that the Fed's efforts to improve employment and keep inflation down have been hampered in recent years by unusually tight fiscal policy. Yes, this is amidst the same Congress that has expanded debts and deficits exponentially, put off the fiscal cliff, for all intents and purposes eliminated the debt ceiling, canceled essentially all sequester cuts, and just instituted a 5% spending increase for fiscal 2014. By the way, how do you think that China is going to react to this news if you take it at face value regarding tapering? So the Fed is going to spend less money monetizing bonds when they were the only ones buying them in the first place. I mean, they've overtly bought 70% of all the issuance, and who knows how much in the secondary market. And now that the Chinese just 2 weeks ago said they're no longer going to accumulate foreign currency reserves, well then, if the sucker of last resort, the Fed, is slowing down, then I guess that means that the Chinese and others are going to have to speed up their selling. So if you think that we're not going to, see much more than $75 billion of QE, I think you're delusional. And particularly, all you have to do is look at those interest rates, which the Fed, you could see, is clearly desperately trying to hold down right now. The 10-year yield, every time it gets to 3.0%, it magically falls back. But eventually it will get back over that level. And if it doesn't, the Fed is just going to, or the powers that be will have to, just start, they'll start making the data look worse. So the economy looks like it's falling apart so that they can, give an excuse to get interest rates back down, starting the whole cycle again. And eventually it'll backfire in their face. Look at all this gold demand around the world. The Chinese had record level of imports in October alone, and they're going to have a double their record level of 2012 here in 2013. Can you imagine what 2014 is going to look like? And by the way, I can't emphasize enough these fragile five currencies, in these nations. We're talking about Turkey, South Africa, Indonesia, India, and Brazil, where a quarter of the population of the world lives. Those currencies have been down 20% against the dollar in the 2 years since it started QE3 and 4. And, after a brief reprieve for maybe 2 months, this fall, after all these governments have intervened to get their, to stabilize their currencies, right after this taper announcement, they started plunging anew. 5-year lows for the Indonesian rupiah. I think 30-year lows for the Turkish lira. I see the South African rand is near its all-time lows. I see the Brazilian real. The government again initiated emergency intervention. So again, regardless of what the Fed says it's doing, what they are doing is exporting massive inflation, and therefore there's gonna be more Treasury selling and more monetization required and more upward pressure on interest rates. As for, it's ironic, we're again supposedly in this recovery. Well, the day after this is Wednesday afternoon, was the taper announcement. So Thursday morning, huge surge in jobless claims for the second straight week. A stagnant, way below expectation Philly Fed with the weakest 6-month business outlook since August. Planned capex spending down dramatically, and we saw declining existing home sales for the first time in 29 months, showing a year-over-year decline. Again, this is the day after taperings based on a supposed recovery. And again, every minor tick up in interest rates, and I'm talking about minuscule, puts additional pressure on an economy that's already in significant trouble, particularly the housing sector, which the BEA itself, the Bureau of Economic Analysis, admitted was half of all the GDP growth in the first half of the year. And again, they smashed gold, not when the announcement was made, but after Bernanke started speaking. We've seen the 2:15 a.m., on Thursday and Friday. Today here, gold pushed above 1,200, and you see, again, the cap at the 12 o'clock, cap of last resort. I mean, this is getting so comical. it's incredible, especially in light of where the inventories of gold are. I mean, look, this very morning we saw the Comex registered inventories plummet by 130,000. That's about 20% of the total, down to a record low of just 490,000 ounces. I mean, we're talking about, maybe $700 million worth of gold, if it's even that much, supporting this whole pyramid scheme of keeping gold prices down. And again, if you look at where we stand on the Comex inventories, right now there's still probably another 500,000 ounces that have yet to be, that have been served, that are going to be served when the December contract ends 10 days from now. And there's 500,000 ounces there. So unless some massive amount of gold comes into the registered inventories, we're going to end the year with next to nothing. I mean, we're talking about nothing in the Comex, in the registered category. And yet we're supposed to believe that gold and silver prices are going to stay down here. For the record, for what it's worth, with all these doomsayers saying, oh, the technicals say this and that, when technicals are ridiculous, the fact is gold did theoretically double bottom at the same level as it was in June, as it hit in June in the 1180s. I don't really care if it goes below there or not, because it's immaterial technically to me. It all has to do with the physical amount, and we're talking about massive uptake, A, from the Comex, obviously, and B, I told you, October record level of imports into China. If they keep prices down here, we're going to see just massive physical offtake, and at some point the whole game is going to end. On that topic, I wrote this week, again, as I do constantly, of the cost of production of gold and silver trading below them. Again, I was in oil analyst for 10 years, and I watched the same thing happen when oil briefly fell below the cost of production in late 1998. It only took about 8 months before the entire industry was collapsing, cutting capex plans. Exxon and Mobil were merging, and price was doubled, a year from then, and 1,500% higher 8 years later. And this is going to be so much worse because gold has been, and silver, the mining industry has been under attack for so much longer. There's no mining personnel anymore. The governments are getting more draconian in their demands. The projects are getting more complex. And of course, we're so far below the cost of production. In fact, Steve St. Angelo, who, I think he's the best analyst out there at covering this particular topic. He's the SRS Rocco report. He put out his report for the third quarter for the silver industry. He was saying that the break-even cost for the third quarter was about $25 for silver per ounce. If you include the $100 million of write-offs, which of course you have to include because companies are in business to make money, not lose it. But even if you took the write-offs out, it was still $22 an ounce. And this is a massive, the reason that these write-offs were there was because all these mines are being mothballed. CapEx is down 62. These are CapEx plans, 62% year over year, and we're talking about the world's largest silver miners. So going forward, you are going to see an absolute, as I've talked about, a plummeting of silver production worldwide, and the same goes for gold. And again, you look at the list of what we're supposed to be. I mean, I've been around this 12 years, supposed to be the big silver producers. Pasco Lama's dead. Navidad is dead. For gold, Fruta del Norte is dead. And then, of course, everyone forgets about the Kennecott mine in Utah, which has been gone for almost a year now. It was 15% of U.S. silver production. And it may never come back. A company like Orcana put out an announcement Thursday that they're putting their major mine on care and maintenance. You're going to see many more like that in the coming months and years, or I should say months, because I don't think we'll be down here that long. But you sit here at 20 or sub 20, and on gold under $1,250, just to pick some arbitrary numbers, you're going to see massive amounts of production go offline. And believe me, it takes a lot to put that stuff back online, a lot more than people think. Once you start laying off people, and and the cost of getting things back. I've seen it in the oil industry, and in mining, I'm guessing it's no easier. I mean, you look at companies like Newmont and Barrick; these are two of the biggest in the world. They this spring cut 30% of their staff just in their headquarters, let alone when they start really cutting into the geology, engineering, and other staff. So anyway, one final topic is Bitcoin. Again, I'm not going to go too far into this, But the one thing I did say, I've been saying, look, there's a difference between the investment Bitcoin and the monetary platform, and I don't really know what's going to happen with the investment. I personally don't think it has any intrinsic value and never will. But what I did say was, if the monetary platform is ever going to be established, it's probably going to go through the kind of vicious attacks over a period of not years but decades from the governments that oppose it, much the way gold and silver have. Except in the case of gold and silver, they do have intrinsic value and a track record. And of course, this week we saw the governments of China, Switzerland, the EU, the United States attack in very, very, very strong ways. The PBOC banned yuan payments on Bitcoin China, which is the largest Bitcoin platform. I mean, these are early stage attacks. And again, it's just, to me, I'm just trying to prove the only real money that's been proven over time is gold and silver. As far as Bitcoin, you can get all excited about it, but if you're going to put your money in it, it's survival of the fittest. I saw Bitcoin at one point was down 60% in a couple of days. Now it's back up a little bit. But the point is, you have to keep your eye on the ball with what's going on in the world. The money printing will never stop. It's only going to increase. And the pressure for governments around the world to sell treasury bonds is only going to increase with every passing day. Hope this helps. Keep in mind, there's just a week left in the year, so you're going to see some crazy tax-related positioning in the markets for the few people that that are still real participants in the market. And I think that there's really been no better time to sit and think about what's happened this year, about all of the money printing, about all of the political and economic negative events around the world, and think what could possibly change to make these better in 2014. And the answer in my mind is nothing. Hope this helps. Hopefully next week I'll have an expert on the Comex come in. We'll see what the inventory looks like as the December contract ends. Have a great holiday, and we'll talk to you next week.